The fear of missing out, commonly known as FOMO, is a powerful psychological force. It can lead to impulsive decisions, especially in the realm of investing. When we see others making profits, especially quick profits, our brains trigger a fear response. We feel like we are missing a golden opportunity. This fear can drive us to make hasty investment decisions, often without conducting proper research or considering the risks involved. Understanding the psychological underpinnings of FOMO is crucial for making rational and informed investment choices. FOMO takes advantage of our innate desire to belong and succeed. We are social creatures, wired to compare ourselves to others. When we perceive others as being financially ahead, it can create feelings of inadequacy and anxiety. This fear of being left behind can be particularly acute in the age of social media, where we are constantly bombarded with images and stories of others' success. The desire for quick riches is another factor that contributes to FOMO in investing. We are drawn to get-rich-quick schemes and often overestimate our ability to time the market. This can lead to chasing after the latest hot stocks or cryptocurrencies without fully understanding the underlying fundamentals or the risks involved. Recognizing these psychological biases is the first step towards avoiding the FOMO trap. Social media fuels FOMO in investing. Platforms are filled with stories of overnight millionaires. These stories are amplified within echo chambers. This creates a distorted view of reality. Algorithms prioritize sensationalized content. Investment successes are more visible than losses. Seek diverse perspectives and credible advice. Our brains are wired to seek pleasure and avoid pain. When we make a profitable investment, our brains release dopamine, a neurotransmitter associated with pleasure and reward. This dopamine rush reinforces the behavior that led to the reward, making us more likely to repeat it in the future. However, this can create a dangerous feedback loop, where we become addicted to the dopamine rush of investing and take increasingly larger risks to chase it. Loss aversion is another cognitive bias that plays a role in FOMO. Studies have shown that losses are psychologically twice as powerful as gains. This means that the pain of losing money is felt more acutely than the pleasure of making an equivalent amount. When we see others making money, the fear of missing out is compounded by the fear of being left behind while others profit. This can lead to impulsive decisions as we try to avoid the pain of regret. The illusion of easy money further fuels the FOMO cycle. We often hear stories of people getting rich quickly through investments. This creates a false sense of urgency and can lead us to believe that we too can achieve similar results with minimal effort. However, investing is not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. Herd mentality is a powerful psychological phenomenon that can lead to irrational investment decisions. It occurs when individuals make decisions based on the actions of others, rather than on their own independent judgment. This can create a feedback loop, where the price of an asset is driven up by the buying frenzy of the crowd, rather than by its underlying fundamentals. There are several indicators of herd mentality in investing. One is a rapid surge in the price of an asset, often accompanied by high trading volume. Another is widespread media coverage and social media hype surrounding the asset. A third indicator is the emergence of a narrative that justifies the price increase, even if that narrative is not supported by the underlying fundamentals. Investing based solely on the actions of others can be extremely risky. When the herd eventually changes direction, the price of the asset can plummet just as quickly as it rose. Investors who bought in at the peak of the frenzy can experience significant losses. It is essential to make independent investment decisions based on thorough research and a sound investment strategy, rather than following the crowd. History is replete with examples of investment bubbles fueled by FOMO. These bubbles are characterized by a rapid and unsustainable increase in the price of an asset, often driven by speculation and hype, rather than by underlying fundamentals. When the bubble eventually bursts, as all bubbles inevitably do, the price of the asset crashes, leaving investors who bought in at or near the peak with devastating losses. One of the most famous examples is the dot-com bubble of the late 1990s. During this period, investors piled into internet stocks, driven by the belief that the internet would revolutionize the economy. However, many of these companies lacked viable business models, and the bubble eventually burst in 2000, wiping out trillions of dollars in market value. Another example is the recent surge in the price of cryptocurrencies such as Bitcoin. While cryptocurrencies have the potential to disrupt traditional finance, the rapid price increase seen in recent years was largely driven by speculation and FOMO. This led to a bubble that burst in 2022, with Bitcoin losing over 60% of its value. These historical examples serve as a cautionary tale about the dangers of FOMO in investing. It is essential to approach investments with a rational and disciplined mindset, and to avoid getting caught up in the hype. Section 6. The importance of thorough research and due diligence. Thorough research is the foundation of sound investing. Before investing in any asset, it is crucial to understand what you are investing in, the risks involved, and the potential rewards. This includes analyzing the company's financial statements, understanding its business model, and assessing its competitive landscape. Due diligence goes beyond simply reading a company's website or relying on social media sentiment. It involves consulting independent sources of information such as industry reports, analyst ratings, and financial news from reputable outlets. It also means being critical of the information you come across and being wary of overly optimistic projections or guarantees of returns. Remember, investing is not a game of the chance. It is a process of carefully evaluating opportunities and making informed decisions based on a thorough understanding of the risks and potential rewards. Section 7. Developing a sound investment strategy and sticking to it. A well-defined investment strategy is crucial for avoiding the FOMO trap. This strategy should outline your investment goals, risk tolerance, and time horizon. It should also specify the types of assets you're comfortable investing in and the criteria you will use to select individual investments. Having a clear investment strategy helps you stay focused on your long-term goals and avoid making impulsive decisions based on short-term market fluctuations or the fear of missing out. It provides a framework for making rational decisions even when emotions are running high. It is also important to diversify your investments. This means spreading your money across different asset classes such as stocks, bonds, and real estate. Diversification helps to reduce the overall risk of your portfolio and protects you from losses in any one particular investment. Section 8. Tuning out the noise, avoiding market hype and panic. The financial markets are constantly bombarded with news and information, much of which is designed to elicit an emotional response. This constant barrage of headlines can be overwhelming and lead to poor investment decisions. Learning to tune out the noise is essential for avoiding the FOMO trap. This means being selective about the sources of information you consume and avoiding getting caught up in market hype or panic. It also means focusing on your long-term investment strategy and not being swayed by short-term market fluctuations. Remember, the stock market is driven by both rational and irrational factors. By focusing on your own research, due diligence, and long-term strategy, you can avoid making emotional decisions and stay on track to achieve your financial goals. Section 9. Seeking professional guidance, a prudent approach to investing. Navigating the complexities of the financial markets can be challenging, even for experienced investors. Seeking professional guidance from a qualified financial advisor can provide valuable insights and help you make more informed investment decisions. A financial advisor can help you develop a personalized investment strategy, select appropriate investments, and manage your portfolio over time. They can also provide objective advice and help you avoid making emotional decisions based on FOMO or other cognitive biases. When choosing a financial advisor, it is important to select someone who is trustworthy, experienced, and acts in your best interests. Remember, investing is a marathon, not a sprint. By following these guidelines and seeking professional guidance, you can increase your chances of achieving your long-term financial goals and avoid falling prey to the FOMO trap.